As YouTube is setting up, let me also start recording. Okay. And we are live on YouTube. Okay. So good evening. Welcome to this session on the Finance Bill 2025. And this time round will be hosted by CPA Dennis Wakaba. Who is CPA Dennis Wakaba? He's a certified public accountant in Kenya. He's a board treasurer, and with 10 years of experience in tax matters, he will be the one taking us through the Finance Bill 2025. Wakaba, welcome. Maybe just a few questions before you delve into your presentation. And the first one being, is this bill really final? What is usually the process? Is this a draft? Is it rumors? Is it budget estimates? What's the process like?
Okay. Thank you so much, Mikaeli, and to our guests and viewers. Thank you so much for sparing this time to be here this evening. And just to respond to your question, the finance bill as it is right now is it's not the final copy of the act that we are going to have sometimes next month. This is just a collection of proposals from the Treasury. From the Treasury taken to the Parliament for consideration, for debates thereafter, until the final act is assented to by the President. And maybe just to take you through in a very brief manner the process of the process of coming up with the fin bill to it being a fin act. The Revenue Authority, and by extension, the Treasury, engages the stakeholders as early as September and October of every year, collecting information, creating the details on the measures that they want to take to include in the coming fin bill. And all this is put together by the National Treasury, and then thereafter, as per the provision of the law, the bill is supposed to be introduced to the Parliament before 30th of every month. Yeah, 30th of, or rather 30th of April, preceding the introduction of, or rather reading of the budgets in the Parliament. And so once now the National Treasury presents the proposals to the Speaker, the Speaker gives it to the respective committee, and now the committee takes the proposals and then returns them back to the Speaker. The Speaker then now introduces the bill, which is now called the first reading, to the Parliament. And then thereafter, the first bill, that is when immediately after the introduction, that's when now we have many things happening, including the public participation, where the Public Finance Committee takes the sentiments of the public, what's the feel of the public. And there has been quite a lot of concern around this, because in as much as we are also taking the public sentiments and the public reactions to the bill, there has been a feel that the National Treasury should as well communicate what really is the intention of the proposed changes. And most of the time, the ministry remain silent on this issue, and which as well can count a good thing, because you also don't want to direct the conversation of the public. And after the first reading, public participation, the bill is then introduced into the Parliament again for debate. That is the second reading, where we see parliamentarians now giving their personal inputs and those of the people that they represent. And then we have the third reading, where minimal changes are made to the bill. And if the Parliament votes to approve the bill now goes to is presented to the President as an act, and then thereafter now the President assents to the act, and the different proposals, which usually do have different dates that those acts and laws come into force, and now they consequently come into law on the provided dates. Yeah.
Okay, that's great and a good summary there. What are some of the key, do I call them priorities, that you're seeing the government putting in place in this particular bill? Do you have any highlights for us?
Yes, I do have. Actually, I do have quite a lot of highlights.
Okay.
But or
Just
maybe
maybe a few.
yeah, just to set the stage, this bill, of course, has come in a very interesting period, in a very interesting
Yeah.
season. And just maybe to take you back, remember we just came from whatever happened post Fin Act, Fin Bill 2024.
Yeah.
And at the same time, we had the court make a ruling on the position of the unconstitutionality as those who are contending were claiming it to be, whereby the Supreme Court actually assented to, or rather, ruled that the Fin Act 2023 was constitutional, save for a few provisions that were ruled not to be found to be a revenue bill. I think I should mention that this is regarded to be a money bill, as per the provisions of Article 114 of the Constitution, and therefore anything that you find in a finance bill should be touching on revenue measures. Yeah.
Okay.
And so the provisions, the Fin Act 2023, were that didn't touch on the Fin Act, or rather on the revenue raising measures, were ruled to be unconstitutional and not to be fit in that particular bill.
Okay. Okay. I think that will be it for now, so that I can allow you to just take us through what are we seeing in this particular bill. Then probably towards the end, and any questions we'll have, we can now float them. I hope that's okay.
Okay. Thank you so much. Again, just to reiterate what you just mentioned, that in case anyone has a question, please feel free to type it.
Have it in the chat.
Yeah, and have it in the chat. Now, again, I just want to mention that the bill as it stands now, it's a bill, it's not an act. Yeah, it's a bill and it's not an act. And I further want to mention something that I have mentioned about the impact, and the precedents that we have that was set by the Fin Act 2023. And quite a few interesting and notable pronouncements were made by the court. And that is, remember we had the issue of public participation, whereby this bill, after being introduced in the second reading of the parliament, and the different changes being introduced, and thereafter the bill not being sent to the public for another public participation, the court actually ruled that this is okay. The issue of public participation was found only to, the provision is that that public participation should not be exhaustive, but rather should be meaningful. And therefore, this is not the final copy of what you're going to have, and we might not be in a position to engage in public participation thereafter. The second thing that was very material to the foregoing with the Fin Bill 2025, it is there was some procedural lapses in the Fin Act 2023, and I will not go into the details of a lapse that has actually happened with the Fin Bill 2025, but the courts actually mentioned that these procedural lapses were found to be insignificant to invalidate the Fin Act 2023, and therefore we expect, or rather we found the courts being lenient on this issue, and therefore I think that was a good precedent set by the Supreme Court. And without much ado, I'll go to some of the proposals. We are going to attempt to rush through them. We are not going to attempt to discuss these issues into details. We're just going to highlight them. And again, if you have any question, please feel free to type the questions in the chat area. So the fin Bill 2025 is going to amend quite a number of acts. And for the conversation this evening, we are going to limit ourselves to the tax acts. In addition to the Income Tax Act, VAT, Excise Duty Act, the bill is also looking forward to amend the Miscellaneous Fees and Levies Act, and also the Stamp Duty Act. We are going to limit our conversation to the Income Tax Act, the VAT, and excise duty. And one very interesting proposal in the bill is to increase the amount not subjected to tax that is paid as per diem. We've had the same amount since around 2006, thereabout, and it was only befitting that this gets reviewed upward to 10,000, which really is a welcome move because I mean, there has been inflation, cost of living really has gone high, and it was only justifiable that this gets reviewed upward. And I must mention that the amount that employees do incur whenever they are on work duties out there, the 10,000 that is not going to be taxable, is also not expected to be supported by an ATM's receipt, and therefore the 10,000, again, I maintain, should not be taxed, and it should not further be supported by invoices for it to be allowable. There is also a very interesting proposal that is to require the employers to deduct all allowable deductions before the computation of PAYE. And there's a slight error in the wording of the proposal. That is whereby the proposal is actually mentioning that all exemptions and reliefs granted in the Income Tax Act are to be allowed before the salary is actually subjected to PAYE. And there's a slight error in that because the way we do it and the provision of Article 29, or rather Section 29 of Income Tax Act, provides that before an amount, for relief to be applicable, it has to count as a tax credit. But the proposal in this case is having this amount as an allowable deduction. Yeah, so that is going to cause an ambiguity because it's going to contravene Section 29 of the Income Tax Act, which provides that this amount that is provided as a relief should be treated not as an allowable deduction, but as a tax credit to the already computed tax. But I also think it's a very good move because it's going to harmonize and limit the issues of employees whenever they are doing the annual returns. We are not going to have a lot of taxpayers claiming refunds. We're not going to have a lot of reconciliation being done. But to me, it is also appearing to be an attempt by the government to push and to have employers remit statutory deductions are provided by the different acts. The NSSF, the Affordable Housing Levy, and also the contribution to the social health insurance fund. And so my expectation and what I'm speculating around this is that the return sheet is going to be locked in such a manner you have to declare this amount. But also, it's going to be rather interesting because not all, if this is going to be pushed to require employers to deduct all the allowable deductions, there's going to be quite a lot of administrative tasks, because some of these allowable deductions, which include interest paid towards mortgage schemes, amounts being paid to post-retirement medical funds, non-cash benefits. You're also thinking of the meals, amounts which really were reviewed upward by the Tax Laws Amendment Act, and also contributions towards the pension schemes, which currently stands at 30,000 per month. And I'm particularly interested with how they are going to administer the interest that get calculated, the interest amount that get calculated in most mortgage agreements towards the end of the month. Yeah, if you look at these statements, that employees have, the interest amount gets or rather reflects in the statements at the end of the month, and therefore, that a monthly communication between the employer and the employee on the amounts that gets deducted, which again, we are not going to be expecting that to be a flat rate. It changes every other time. This rate gets reviewed every other time, and the interest also keeps on changing depending on many factors, like how much has the employee been in a position to pay and all that. And therefore, we are going to at least expect that the return sheet is going to be locked to at least allow, or rather require the employers to at least declare and remit the statutory deductions that are granted to all employees. The other thing that is going to change is that the withdrawal from the pension funds is now going to be locked. We had a very interesting provision whereby employees could access a portion of their contribution to pension schemes subject to some certain provisions and subject to some certain limits. Like, for instance, employees could access 60,000 of pension contribution per year, tax-free. And so there's a proposal to lock, or rather to remove this allowable, or rather tax-free withdrawals from the pension schemes. But also something positive that has happened towards the contribution towards the pension scheme is that the contribution, the gratuity contribution to public and both now private scheme, at the point of withdrawal, is going to be tax-free. But now these withdrawals are going to be locked until either retirement age as defined by particular pension schemes, or being in that particular pension scheme for the provided number of years. And also, if, like, for instance, an employee withdraws that pension for reasons of illness, so those will be the only exemptions that employees can now access their pensions free of tax. And just to emphasize that one of the positive thing that we've noted around this space is that now the withdrawals from private pension funds are going to be free. Those contributions that were made as gratuity. Yeah. Initially, the provision was to only allow deduction from a pension scheme, from a public pension scheme, and not not a private pension scheme. Moving forward is the expanded definition of royalties. We saw an attempt, or rather we saw a change that was introduced by the Tax Laws Amendment Bill, expanding the definition of royalties, and this brings within the ambit of withholding tax close to every other payment that is being made, that is being made as regards a payment that can be attached to a software. And so there was an expanded definition. There's an expanded definition on the requirement to withhold, including but not limited to subscription and other types of payments. And so the FIN bill is now attempting to expand the definition of payments that would require the payer to withhold, to subject the payment to a withholding tax, to include the distribution. And this has been a very contentious issue since 2023. And we had a very interesting ruling in the court whereby the court reaffirmed that, income earned as a result of distribution, which the FIN bill is proposing to tax, are to be treated as business profits. And therefore, we expect that this is going to be looked into and hopefully repealed, so that it doesn't contradict the international best practices. We are also seeing a cleanup around the withholding tax on tax and on scrap and supplies to government bodies. The Tax Laws Amendment Act introduced withholding tax on supplies being done to government MDAs, to public entities, as defined by the Income Tax Act. But also, it also introduced a withholding tax of 1.5 on scrap, on the sale of scrap materials. But now there was an error that was done. There was a gap that was omitted, and therefore the FIN bill is aiming to correct this by introducing these new introductions into Section 10 of the Income Tax Act. And so, yes, they defined this to be sources of income. Yes, they provided the rates in the third schedule, but they forgot to subject these sources of income to withholding tax. And therefore, in my view, between December, or rather between January of this year and until this bill now comes into an act, there isn't a legal provision that requires the taxpayer to withhold. And until this correction is done, it is until then that the taxpayers will be required to withhold as per the required rates. So we can only hope that this is going to be successful, so that it cures that gap. So there is also an increase in the definition of the significant economic presence tax. This was introduced upon the repeal of the DST. Yeah, we may remember we had DST that was being whereby taxpayers who are providing services in a digital marketplace were then required to, their revenue was being taxed at 1.5%. And so there's significant economic presence tax now replaced the DST at the rate of 3%. And so the bill is aiming to expand the definition, or to bring more taxpayers into the ambit of SEP by expanding the definition of, by expanding who really comes on board. And that is, in addition to those who are doing business in a digital marketplace, then any business, literally any business that does business online and falls within the definition of who is required to be subjected to SEP will then now be taxed at the rate of 3%. We also have the donations. The government has been putting a lot of effort into sealing the loopholes that are being exploited in the name of donations. And just to mention in passing, we have the regulations which were published sometimes last year, particularly to charitable organizations which are supposed to comply by next year, or rather by next month. And the fin bill is further enhancing the donations, the taxation of donations, whereby contributions being done towards the construction of public sports facility. An emphasis here is being given to public sports facilities. So it has to be public and it has to be facility. And I'm stressing the two because if you look in the next slide, the bill now seeks to repeal the provision that allowed taxpayers who are sponsoring sports activities. Yeah, maybe you're sponsoring a team, you had been allowed to claim the amount that you're expending towards that sponsorship as an allowable deduction. And so what this bill is now doing is limiting donation on issues of sports to donation particularly to a public sports facility. And so employers will need to reevaluate on the implication of this, because, and top of my mind really is that it's going to have an implication on most teams, as we know, that play in our leagues that have a lot of private sponsorship. We also had a very interesting provision that is aiming to limit the loss carry forward. Currently, if an entity is on a perennial loss position, taxable loss position, that is taxable losses, which really are very different from accounting losses, then that institution is allowed to carry forward these losses for definitely. But now the bill is seeking to put an end to this, limiting the claiming of these losses to 5 years. This, of course, is going to impede those taxpayers which really engage in a capital intensive activities and investment. And this particular proposal is also going to nudge the decision makers of institutions and companies towards things that we wouldn't want, things like earnings management. You want to think of billing and delivery. You want to think of income smoothing for manufacturers which engage, or rather who engage in capital intensive projects, and also the method that is called the cookie jar method, whereby in good and bad years you provide more for warranties, and then you do reversals in the bad years. And therefore, if an employer then is going to engage in capital intensive projects, then I don't think this is one of the intentions that the bill has, and therefore this should be relooked into, so that the government doesn't provide a reprieve to them, and now puts a limit on the same, denying that incentive to that particular taxpayer. And so maybe the suggestion then would be retain the 5 years, but now require that after the lapse of the 5 years, let the taxpayer approach the commissioner to allow for the extension of time. Still have it carried forward indefinitely, but after 5 years, require this to be applied require an application to the commissioner for the continual application of the tax losses. So this is just a continuation of on the carry forward of losses. And the other rather administrative proposal that the bill is seeking to do is requiring the commissioner to respond, where a taxpayer has made an application for a change of the accounting period. And so the wording of the law as it is doesn't mandate the commissioner to get back to the taxpayer upon the application for the change in the accounting periods. And this is a welcome move. Albeit it will be very interesting to see how this gets enacted on iTax, having in mind that really it's not an automated process. But then again, in the age of IT, advanced in IT, we can only hope that that the authority is going to find a way to incorporate this change into the iTax system. There is also quite a lot of discussion around the exemption on capital gain tax act, with amendment being done to the 8th schedule. Whereby the bill seeks to exempt transfers to companies where a company where we only have one person holding the shares 100%. And so the properties to these particular companies, the transfer of this property to this particular company that has 100% shareholding as an individual is going to be exempt from capital gain tax. However, then there needs a correction to the Stamp Duty Act, whereby we expect that the same transfer as the same transfers anchored, the same exempt transferred anchored in the 8th schedule are exempted from stamp duty. We also expect that this particular transfer will also be exempt from stamp duty. And so we hope that there's going to be that introduction of exemption from stamp duty with the respective amendment. There is also quite a lot of amendments again to the stamp duty, whereby anchored both in the Stamp Duty Act and also in the Income Tax Act, transferred initiated by the commissioner are now being proposed to be exempt from stamp duty. And this is whereby the commissioner has subjected a taxpayer's property and wants to sell that particular property so that the commissioner can claim the taxes that are due from the taxpayer. This particular property had been subjected to stamp duty. And so, to make them more appealing and to exempt the taxpayer who is going to buy, or the person who is going to buy, from paying more taxes, now the bill is proposing to repeal the sections both in the Income Tax Act and Stamp Duty Act from from stamp duty for transfers initiated by the commissioner, which really is a positive move. There is also the extension of period upon which the commissioner is required to issue a tax exemption certificate. There are certain institutions and certain transactions really that are exempted from tax, and upon application, there has been a review upward, whereby the commissioner will now be required to issue an exemption certificate from the current 60 days to 90 days, which can only mean that with the recent requirement by all charitable organizations to comply with the exempt regulation. Certainly, the commissioner must be a little bit overwhelmed. And so the extension of the days is going to allow him to review these applications for the extra 30 days. But also, we can only hope, that the commissioner will now not feel they have extra time, and so they can take up all the time they have. We can only hope that they are going to process these applications in good time. One very contentious issue that the bill is seeking to do is to give the commissioner the power to very private and personal data of a taxpayer. And this is, and really this provision doesn't make sense to in any way that you may look at. And this is because if you're giving the commissioner the power to assess the private data of the taxpayer's customer, then I don't think this in any way helps the commissioner to even make an assessment. Yeah, so this provision doesn't have any bearing between the role and the mandate of the commissioner, which is to administer the provisions of the Tax Act, and we can only hope that this is going to be repealed. And another exemption that had been granted to the taxpayer, whereby the commissioner had not been allowed, or rather was not being allowed to assess trade secrets. So the bill is currently proposing to repeal this. And again, like I just mentioned, there's really no bearing between trade secrets and the mandate of the commissioner. Yeah, there's no bearing between trade secrets and tax assessments. One may maybe argue that it might be necessary for the reason of transfer pricing, but still, perhaps this needs to be relooked into. It needs proper wording so that the information of the taxpayer doesn't get misused by the commissioner. We also saw a very interesting introduction, and that is the introduction of advanced pricing agreements. And advanced pricing agreements was one of the most lobbied, expected proposal in the bill, in the many platforms, both by the taxpayers, both by tax consultants, and everyone. Everyone wanted this introduction. It had been suggested to be introduced by the Fin Bill 2024, but of course, it not being enacted, it being nullified, meant that, and it being positive meant that it would only be introduced during this Fin Bill 2025. And an advanced pricing agreement is an agreement, a binding agreement to the commissioner, whereby a taxpayer approaches the commissioner to agree on quite a number of things revolving the transfer pricing. And an advanced pricing agreement requires the taxpayer to provide certain information to the commissioner, and then upon the provision of this information, then the two, both the taxpayer and the commissioner, can agree on the appropriate transfer pricing method, which sometimes can be very subjective, which can sometimes leave the taxpayer with a lot of uncertainty. But upon an agreement on an appropriate transfer pricing method, then this will go a long way in giving the taxpayer the certainty, the much needed certainty moving forward, with no worry that the commissioner will in coming days come and audit the method that the two parties agreed on. There is a limit whereby that the commissioner can audit many other things, but he or she cannot audit the choice of the method that has been agreed. This is not to mean that maybe upon the discovery of information not being fully disclosed to the commissioner, and other things such as maybe a change in business methods, a change in economic position of the taxpayer may not prompt a change in the method of transfer pricing, but it gives the taxpayer that certainty moving forward that they can comfortably apply the transfer pricing method that was agreed between the taxpayer and the commissioner moving forward without a lot of concern to the taxpayer. Worth to note that the taxpayer in such kind of an agreement is required to notify the commissioner that there has been material changes in business methods and any circumstance that would warrant a review of the method that was previously agreed. The bill is also proposing to review downwards the rate of the digital asset tax from the current 3% to 1.5%. And this has been one of those taxes that has been very contentious because the digital asset tax is levied on the gross income of the taxpayer and not on the profits. And so a downward review is a welcome move, but also could be considerably higher because like I just mentioned, the taxpayer is not allowed to claim expenses and those kind of things. And additionally, the 1.5% is required to be submitted by the owner of the trading platform. And so those who trade in cryptos, in digital assets, are the one who really stand to benefit by this proposal. VAT refunds have been attracting a lot of concern. With the commissioner, whereby the word is that there has been refunds being claimed that are not justifiable, and this now reasonably introduces a proposal to amend the VAT Act, whereby the commissioner will now have time to review this application of refunds from the current 12 months to 24 months. Yeah, again, this is just so that to give the commissioner enough time to review these applications. Inadvertently, the taxpayer may lose with the increase of time. The taxpayers may lose, whereby the commissioner may at times be unreasonably taking much more time to review the refunds. And we can only hope that this can at least maybe be reviewed, if necessary, upward maybe to 18 months. 24 months is quite a lot, and so many taxpayers are going to lose if this is enacted as is. The refunds on tax on bad debts. Yeah, currently, as the VAT Act is worded, taxpayers are allowed to claim VAT on bad debts after the lapse of 3 years, and the bill is proposing to review this downwards from 3 years to 2 years, which really is a welcome move. And I must mention at this juncture that there's that confusion between the claim for allowance of bad debts that is anchored in the Income Tax Act and the claim on VAT on bad debts that is anchored in the that is anchored in the VAT Act. The claim of VAT on input on bad debts is a little bit flexible for the claiming of the VAT, as is opposed to the claim for allowance that is anchored in the Income Tax Act. You need not have so many approvals, like renegotiation, renegotiation of terms, show of even going to the court, approaching the lawyers, and taking an extra effort to renegotiate the terms. This is not the case with the VAT Act. For the VAT Act, it's a little bit flexible. You need only show that you've tried to reach out to these bad debts, and then you would be in a position to allow you'd be in a position to claim the VAT on the debts that have become bad. Yeah, and next in line is just a clarification or a cleanup that is going to be done on the VAT, still on the application of the VAT refunds, whereby previously there was an ambiguity in the VAT Act whereby the VAT Act had two provisions that allowed the taxpayer to refund the commissioner upon the realization of the VAT, the input VAT earlier claimed, that the taxpayer had been required to refund this amount after 60 days and 30 days. Yeah, so there's a cleanup whereby the taxpayer is no longer going to be required to, that ambiguity is now removed, that of 60 and 30 days, and the taxpayer will now be required to refund, the realized input VAT back to the commissioner after the lapse of 30 days. Yeah, and I must mention that if you're a taxpayer and you come by such kind of ambiguity, it's important to note that this kind of ambiguities are interpreted in the favor of the taxpayer. So if, for instance, you have an ongoing case whereby you're in a position to get to this person to pay you, and you are having a review and the commissioner is claiming, then the commissioner should allow you to claim, or rather to refund this money after 60 days and not 30 days. There's also quite a lot of transition from VAT exemptions and zero rating, and we've seen quite a lot of changes. We've seen quite a lot of movement from zero rating to to exempt, and exempt to zero rating, and exempt to also standard rating. And just so that we're on the same page, there's quite a lot of distinction between VAT exemption, VAT zero rating, and VAT standard rating. When we talk of VAT exemptions, we mean that if, like, for instance, you're in the business of selling unprocessed food, unprocessed commodities, these commodities are majorly classified as exempt. And so what happens is that if you're dealing with such kind of things, they've been classified as exempt, the input VAT that you incur, you're not allowed to claim. If, like, for instance, you're paying rent, and rent being a commercial rent in this case, and that being standard rated, the VAT input that is in your invoice, that is in your rent invoice, then you're not going to be in a position to claim that 16% that is in that that invoice. Comparatively, if somebody is dealing with zero rated products, then they are going to be in a position to claim the VAT component that is in that particular invoice. And the rate of VAT in this case is 0%. It's treated as a taxable supply. Yes, it's taxable, but at 0%. But for the exempt products, they are not taxable. They are not treated as taxable supplies. Whereas for the zero rated, it's rather taxed at 0%. And this now, like I just mentioned, allows you to claim the input VAT that you incurred in the purchase, in the supply of in the supply of your goods. And maybe just to mention in a very broad manner, some of the reclassification that we have witnessed is the shift from exempt to standard rated of materials, supply of materials for affordable housing program. We've also seen the shift from exempt to 16% of specialized solar and wind equipment. We've also seen a change from exempt to 16% of inputs and raw materials used in manufacture of passenger motor vehicles. And some of these things, I feel, in as much as the recommendation of the medium revenue strategy paper is to clean up the provisions and the exemptions, I feel the motivation behind this is because of probably low uptake of the exemption status of these provisions. And this communicates that in addition to the tax incentives being given to manufacturers and taxpayers, the government need to go ahead and provide other incentives that really are not tied to taxation. Additionally, some of the things that have moved from zero rating to being exempt is the transport of sugarcane from farms. Yeah, this, as it stands right now, is zero. It's zero rated, but it's proposed to be shifted to exempt. And of course, this potentially now means it's going to increase. The price of sugar. There is also the shift and the change from zero rated to exempt, the supply of electric bicycles, the supply of solar and lithium-ion batteries, and also input of raw materials of locally purchased or imported for the manufacture of animal feeds. And of course, this now means those products are going to go high in cost. The next change that we've seen is the application of the excise license, whereby the commissioner will now be required to, upon application of an excise license, because we all know, or we might not know, that taxpayers dealing with excise-able goods are required to make an application for an excise license with KRA. And now the commissioner is required to give feedback after the lapse of 14 days. Yeah. So the next change is the referred to the commissioner on VAT claim and recovery, and I think we've mentioned that. There's also the redefining of digital lenders, whereby the scope has actually been increased to bring much more digital lenders into the ambit and the provision of the Excise Duty Act. There's also a very interesting proposed change, and that is a definite definition of what really are some of the payments that do not require an exemption of ITIM's invoice. And some of these payments, if, like, for instance, you're paying for an import, if you're expensing in your books a payment for interest, if you're expensing in your books an airline passenger ticketing, if you're expensing in your books payment of salaries, if you're expensing in your book, or rather, if you're accounting for investment allowances. And investment allowances, this is as per the provided rates on the different investments that the taxpayer may make. So there was a deletion of the term similar payments, giving a little bit of certainty, but I felt it was not very wise to delete the term similar payments, because there could be other not yet envisioned in the act or in the business practice that could fall within the ambit of similar payments. and such payments that really the commissioner has not envisioned yet. There is also now the power to correct taxes from non-residents who do not necessarily have to have a physical location here in Kenya. And, the commissioner will now have the power to issue agency notices to taxpayers who may be holding money on behalf of these non-residents. There is also the penalty for failure to deduct or withhold tax, whereby currently, if you are required to withhold tax and you don't do it, then the tax that you didn't withhold to the person that you're paying becomes due from you. So now what the proposal and the bill wants to do is to only require the taxpayer to incur penalties and interest if and only if the person that they were paying has declared this particular income that was not subjected to withholding tax, and that really is a positive move because it only meant that the taxpayer was being taxed twice. That is on the income on the income of the person that they are paying. This person declaring this income and then being subjected to tax, and the taxpayer also now being subjected to withholding tax on the different tax on the payment that they are making. And so the courts really have been ruling in the favor of the taxpayer, because the feel really has been that this income was being taxed twice. Yeah, so I think we've touched on that, on the issuance of the agency notices, but also the most interesting thing is that, and why this provision should be relooked into, is because the commissioner will now have the powers to issue agency notices to taxpayers who have ongoing tax cases in courts. And therefore, this is not a very good move, because if really I have a case that is ongoing in court, then I should be allowed to seek justice, and reasonably so. Yeah, so this is a provision that should be relooked into to at least exempt a person who is pursuing justice from being required to pay tax that is already in dispute. There is also a review of the days for processing of refunds, whereby this is going to be reviewed from the current 90 days to 120 days upon application by the taxpayer. And where such refunds are under audit, where the commissioner is auditing those refunds, then the commissioner will now be required to give a feedback after 180 days, up from the current 120 days. There is also a positive, and I note that our time is very much spent. There is also a positive introduction whereby we've had all sort of experience with e-teams, whereby you do your filings, and then e-team erroneously calculates penalties and interest for you, even where that is not justified. So the commissioner will now have the powers to waiver these erroneously generated interests and penalties. So previously this was not anchored, and therefore really it's a positive move. The other positive move that we've witnessed is that the commissioner will now be required to provide a reason as to why they are giving an assessment. I want to believe that some of us have come by this assessment, whereby the wording really has been, the information available to us show that you ought to have paid this amount in taxes. And this has been disorienting the taxpayers, because the taxpayers, when they are lodging the objections, then they need to know they need to know what really am I objecting? Yeah, what information does the commissioner have? Yeah, and so the commissioner will now be required to provide the reasons for assessment. So this is a positive move. Of course, it's going to now require the commissioner to go an extra step into providing the reasons, and also the taxpayer will now have grounds to lodge an objection with the commissioner. So thank you so much for your time. Thank you so much for paying attention to this webinar. And additionally, there is quite a lot of changes that the bill has actually proposed, and this is just some of them. In the interest of time, we just had to go through them in a very broad manner and in a hurried manner, and we can only hope that should you want much more clarification, should you want much more detailed analysis of this, I'll be sharing this with Mikaeli so that he can actually distribute to those who are either watching on YouTube. If you would be comfortable, you can drop an email with them, and also those who registered for this webinar. Yeah, and without much ado, I wish to take this conversation back to you, Mikaeli.
Thank you very much, Dennis. I think for now, you've done a really great job. I didn't know about the sports sponsorship, and then you've broken down the concepts into understandable bits. So I'll open the floor for questions in case there are any. Anyone? And thank you for joining. I can't see a hand. Okay. Okay. I think, Dennis, you've done a great job at dissecting the topic. So we'll call it a day today. And I hope that for anyone who has a question or needs the material, you'll just reach out. My email is justsangjess@gmail.com. You can just reach out and let us know or even engage further. CPA Dennis is a practicing tax consultant, so you can always reach out to him on anything tax related. Thank you, everyone, and have a lovely evening. See you in the next webinar.
Yeah, so top of my mind, Mikaeli, is that is that maybe you can provide your email in the chat area, because I note there's quite a number of people who are typing in there.
Oh, okay.
Yeah, so that they can take up the email and probably reach out.
Well, then I'll just stay on for a bit so that anyone who needs to take it can pick it up. Okay. Thank you, Dennis. Though we've not seen you.
It's okay. I'm still in the office, so I should be leaving in a short time.
Okay. Okay. Thank you. Have a lovely evening.